Hello traders, and welcome back to another market analysis by Financial Hub. My name is Tarrus and I'll be the one taking you through a couple of markets that I'm watching for the week, a couple of trade ideas I have for the week. These are just personal ideas again. Don't let them conflict with your ideas, or probably it's just not financial advice. This is just what I probably am looking at. So it's an interesting week. Today's on Wednesday as I'm shooting this. And we had some inflation numbers coming out from the UK. Very positive inflation numbers. Inflation dropped all the way from 3.5% to 2.3%. So that is showing that higher rates in the UK again are really working to bring down inflation. So interesting thing happening for the pound. As you can see here, I'm watching the pound against the dollar. You can see today we've had some push towards the R2 level, but I'll just slowly first of all start with the fundamentals, then I'll come back to the technicals. Okay, so fundamentally this week I was focused mostly on two data points, and actually most of them are coming out today. So I use trading economics for my fundamentals. Also you can be looking at other websites like Forex Factory. They also have good data. So you can see it's a highlight. The second article says UK inflation rate at 3-year low. So the annual inflation rate in the UK eased to 2.3% in April 2024, the lowest since July 2021. If you've come to my fundamental classes, you understand the impact of inflation to asset prices. Basically, assets, basically I mean the currencies and the stocks majorly. There's a direct relationship between inflation and the other side of the effect, which is basically what happens to maybe the pound, what happens to the UK stocks. Probably when interest rates are shifted, or when inflation is too high, you might find central banks probably hiking rates or tightening the access of money, and that makes probably a certain currency stronger. So you can see today inflation rate coming down. That is because over the years, major global economies during COVID suffered from inflation. I think you can attest to that, because there were very low interest rates when COVID was there for maybe since March of 2020 to March of 2022. So those low interest rates environment made access of money very much. People could easily get the dollars in the streets, the pound in the streets, and we saw some of these currencies really losing value. But again, at the same time, inflation again really picked up. So to bring down again inflation towards the start of 2022, most central banks globally again started raising rates. Even here in Kenya, we saw central banks raising rates until now, whereby it's now at about 13%. So what is the effect probably of that in the long term? I'll try to look at it because the American inflation rate came out about 2 weeks ago. And inflation rate came out about 2 weeks ago, and it was not really positive, because it just moved from 3.5 to 3.4. So the progress in the UK to bring down inflation is probably more faster than in America. So you need to look at these things as you try to understand where markets will move in the long term. You don't really have to trade these movements or these fundamental data points, but it's very important for you to understand long-term developments of where markets can go. So that is the goal about fundamentals, just to give you a long-term idea of where can markets go in the next, maybe a year, 6 months, or even 2 years. And when you have that idea now, or that bias, now you can position yourself technically to take advantage of the market movements towards whatever direction. Yeah, so as you can see, inflation rate in US remained at 3.4%. Not really remained, but dropped from 3.4 to 3.5 to 3.4. But as you can see in UK, okay, this is not yet updated, 3.2. It should be at about, let's click and look at it. Yeah, the March reading is 2.3%. The average, the average price, or the average percentage for the UK inflation rate is always 2%, also for the US. But as you can see, during COVID, since 2020, inflation just started picking up. 2021 was the most significant. Markets moved all the way from about 1.5, moving all the way to 11%. So the cost of living was very high at that time. We saw again the Bank of England raising rates similar to the Feds. Most central banks raise rates apart from probably the Bank of Japan, which again raised rates just the other week. So at 11.1%, the pound was, basically the UK economy was not really doing well in terms of inflation, and the government had to, so not the government, the central banks had to raise rates to, so let's look at UK interest rates. So you can just, United Kingdom interest rates, 5.25. Just want to give a brief understanding of, probably because I am the one who does this class on our course. I teach a lot of fundamentals, so I just like going through a bit of what is happening at the fundamental front, apart from the geopolitics, and I like focusing on the economics of how markets work, and basically that is the understanding of the levers of how central banks will supply or not supply excess of money. So understanding that thing is very critical. So you can see we moved from 0.1%. As you can see, let's put a 5-year graph. So you can see the interest rates stayed very low since March all the way to January, around January 2022. So a very low interest rate environment. Then you can see that again the opposite, a high interest rate environment. So since COVID, we've seen a lot of market shiftings in terms of how interest rates have been performing. We've seen low interest rates whereby stocks markets did really well. The US 30 moved up 100% from the COVID low. We saw, most billionaires being made during COVID and all that. So that is from the fundamental perspective. But now, what does inflation coming down to 2.3% mean probably for pound and even for other markets? Because I think this number coming out today, we have to, crunch it and try to understand where can markets move in the future or in the long term. So inflation coming down to 2% because, again, higher interest rates are not really good for businesses, fixed investments. So you'll realize that when interest rates are too high, probably it can, again, bring up unemployment because companies are not doing really well. So that is the challenge about higher interest rates. So again, probably probably help unemployment go down, to help businesses or to stimulate growth, most governments, again, central banks will choose to lower rates, especially if inflation is settled down back to 2% and unemployment is also settled below 4% for most global economies. So that is probably what I'm trying to interpret. So with lower inflation coming out today, earlier today, on Wednesday, 22nd of May, will the Bank of England now probably move faster towards being in a dovish tone or in a dovish environment? Basically, that means are going to start lowering rates from that point now? And that is the question that I'm trying to just answer in my mind and just to picture. If they're going to lower rates, what does that mean again for the currency? What does that mean for the UK stock market? The FTSE and other assets around the United Kingdom. So yeah, lower rates for longer or higher rates for longer. So for me, I'm looking at globally again, not just for the pound. I'm looking at also for the long term for dollar. The dollar is struggling a bit with inflation. Inflation has been sort of persistent, above 3.4%, above 3-point-something% over the last almost couple of years. And the last time Powell talked, I think if you've been following what the Powell narrative is, they are not ready to still lower rates at the moment because of the inflation numbers staying up. And again, they're not really planning to keep rates higher for longer because, again, it can be harmful or it can hurt a lot of markets, probably especially businesses and stocks, and and unemployment can spiral up again. So that is the narrative about fundamentals. It's very good for you to understand this structure in the long term. So in the short term, again, you can take your trades technically. You can probably be using your support, your resistance, your patterns. But do you have an idea of where probably markets can move in the long term? So that is the first part I wanted to cover on the fundamentals. I think today that was the only, not that only that. I think also we have, when we go to the calendar, we have FOMC. So I like using the high impact data. Yeah, at 9 p.m. tonight. So probably this video, you'll catch it later. But we have the FOMC. FOMC is basically the Federal Open Market Committee. the Committee of Central Bankers in America. So we will be receiving their minutes from their previous meeting. So as you can see, they've been keeping rates again similar to the UK flat since July. And that is probably why again inflation in America has been a bit stubborn, staying above 3.5 against their target of 2%. So again, higher rates are still probably gonna be there, especially for the dollar again, until we see inflation probably dropping down towards 2, maybe below 3, 2.5. Towards that level, probably we can be confident now that the Feds are gonna lower rates. And if they're gonna lower rates, we know how does that mean for the dollar. If you want to understand, I won't really explain all that, but you need to understand that perspective, what does higher rates mean for currency, what does lower rates mean for currency, and for stocks, commodities, and even cryptocurrencies. They're really affected by all this. We saw Bitcoin moving heavily when there was low interest rate environments in 2020 to 2022, because there was free money and money could flow into riskier assets. So that is the idea about fundamentals. So if you're gonna see higher rates for longer, I'm probably gonna be still looking for dollar to still persistently be a bit stronger. But again, I'm seeing markets losing sort of a sense of direction at the moment. Markets are a bit choppy because of that uncertainty about when interest rates are gonna go down. So that is again a very critical move that most traders, I think, globally are watching, to see the narrative of where Powell will signal where the markets can go, because the Feds again really signal to us where markets can go. We caught that bullish move on stocks since 2020 when interest rates went down. Gold, we were in that move. So you can realize easily by understanding the fundamentals of markets, you can now know how to position yourself technically and take advantage of those market movements. So yeah, on the fundamental front, I think a lot of uncertainty, especially for the dollar. If you listened to the last speech by Powell, he was giving mixed signals so much about basically where rates can go in the future. And he was just, we will make decisions data by data, incoming data by incoming data, and we will make appropriate decisions according to how numbers come out. So a very cheeky chairman, but I think he's doing his job well. Inflation rate, despite persisting at 2%, we've come a long way from 9.2%. So let's hope probably towards the end of the year that number comes down so that we can get a clear direction for the dollar. I feel like currently, with the uncertainty of where markets can go, we don't really have a clear direction for where can the dollar, lead us. And, that can give us a direction for stocks, a direction for commodities like gold. So, yeah, that is, on the fundamental side, I feel like a lot of, let's look at the minutes coming out today. You can also probably check it out on your own, probably when you're watching this and you realize you didn't. You can go back and check what's happening on the minutes. So that is critical on that. So I'll just quickly, check up some ideas that I have in the markets currently. So for me, again, I trade a bit differently from my partners, Ken, Caleb. I think we all trade differently. Caleb is a patterns guy. I'm an indicator guy. Ken also uses an indicator with patterns. So yeah, I use an indicator called pivot points. Might be new to some people. For my students, I think most of you have already familiarized yourself with the indicator. So I'll just look at some of the markets. I'll start probably with some stocks. What's happening on the stock side in the long term? Why are we seeing a very strong bullish market from a fundamental perspective? So you can see since January, on the daily time frame, since January, you can see US 500 top 100 companies in America, Standard & Poor, from 4,600 all the way to 5,000, making new highs just this week and last week at $5,325. So that is a very strong move. Let's see what percentage move is that. Yeah, so markets in 138 days, we are up almost 14%. In maybe let's say Q1 plus maybe 4 months, the first 4 months, markets are up about 14%. And this is always the benchmark for American investments and traders as at the investment level, most investors will benchmark your returns with how the S&P is performing. So already if S&P is performing at 14% already by this time, that means again there is a very huge, probably, most traders again will really struggle probably to beat markets if you don't perform above 13%. And this is just for 4 months. Now imagine, most traders again, you can realize most traders probably are losing or less than the 13%. But I can attribute this very strong bullish movement to the interest rates, because also you can see that the same thing from the Dow Jones. Actually, the Dow Jones has moved even significantly higher. If you look at the Dow Jones from November, see we made new highs about 23% now. So Dow Jones is already up 23% in 208 days. So again, you can see markets are up, stock markets are up. You can see the previous almost since 2023, the whole of 2023, we didn't really have that huge move. We were sort of consolidating. And that is because that is when interest rates, were rising. When interest rates are rising, it becomes difficult for stock markets to move higher. But since it got to a point whereby now the interest rates stopped moving higher and capped at 5.5%, with the idea that that number is already too high, the central bankers are not looking to extend rates higher. That is why for me now I attribute this 23% move, and not only on also on Dow Jones, also on NASDAQ. Most stocks have been moving up, and that is because I try to look at it like this. Markets are always ahead of the economy. So markets will already be up before even the economy, picks up. So you'll realize like before basically the inflation numbers go down, and before interest rates now starts to go down, for stocks to do good, the stock market and traders, basically speculators in the markets, always have that narrative or idea already before even the market shows it in real life. So you'll realize that currently, at the current environment, yes, we have rates at 5.5. If you listen to how central bankers have been speaking, they're not saying that they're not going to increase rates, but they're saying there is a very high chance that that 5.5 will be the cap, and they look to reduce rates. So that narrative already goes to the traders' mindset that in the long term, Feds are going to reduce rates. So earlier, you start getting into that trade earlier, start buying those stocks earlier, because, in the next 2 years or in the next 1 year, this market will be moving up, and I want to make money with that movement. You don't want to make money at the peak of that move, probably when now you realize that rates are now going lower already. Rates have been moved lower. So traders like to catch that early worm, catch that trend, or from the wave moving upwards. So you'll realize that is why probably if you look at the weekly chart on US 30, the market has just, after a long consolidation, you can see since 2022 January, when rates started to move up, stocks moved down. You see, higher rates are negative for stocks. If you can understand that, from the basic understanding of markets, higher rates are negative for stocks. But now at this point, it has become clear since October, November that these rates are not going to move up anymore. That is why you can see stocks moving up, and we've been making new highs. Dow Jones is now currently making new highs at the 40,000 level, historical levels that are not seen before. So I think it was just seen about April, May. So for this year, we have seen stocks really moving up. Stocks are moving up. So the direction is clear to the upside. But now again, as markets move now, probably let me now break it down to a trade that I have for this week, and also had a similar trade last week on the Dow Jones. So I trade from the hourly time frame. So on the weekly chart, I just like to look at the big picture, look at what is happening. So yeah, I trade a specific pattern called a magnet trade. I wouldn't really touch everything about it because that is very valuable for to just publish it here. So and that is why again actually I like keeping my strategy pretty private, apart from probably my clients. So yeah, this is Dow Jones. I had a trade last week. It turned out pretty well, but again, it became a bit challenging. It didn't really hit my targets. I came out at break even, did my own madness on that trade. But I'll just explain probably the idea behind it and what is a magnet trade. So probably you can get curious about wanting to know what does Tarrus trade. So my idea last week was to short US30. I know the trend is to the upside, really clear. We've looked at it from the weekly chart. Markets are moving up, we've made new highs. But as market moves up, I like taking advantage of market dips. After a market maybe hits a specific level, a key level, and for me again, from how I understand pivot points, my support levels and resistance, I can know how to position myself around getting good dips or corrections before a trend continues. So last week I was having this trade on US30. Probably let me look at the 2 hours. Yeah, so a magnet trade is basically towards the open. I won't really explain it or go deep into it. I'll just probably explain why I took the trade. If you really want to learn, it's a whole thing. I take so much time to explain this in a class, so I can't put it in a 25-minute video. But my idea here was when markets opened last week on Monday, markets opened outside what I call equilibrium. The P level is what we call equilibrium. My clients, of course, I think you will understand what I mean by this. So this is equilibrium. Markets open outside equilibrium. That for me is a market inefficiency. So I'll try to take advantage of that market inefficiency from the markets to cover up that inefficiency before the trend can continue. Okay. So last week the market, and again, I don't just enter the market at that point. Remember again, if I put more pivots, this might be very foreign for some people, but you might need to spend some time with me to understand this. So last week again, markets, you can see markets came and closed at the R3 level, a very strong resistance level. So I was really aiming to see some weakness in the stock market before the trend continues towards the early in the week. So we had that market came again, opened on Monday, moved to R1. R1 is where I get my entry. And from R1, I was aiming for this market to recorrect back to equilibrium and I get out of that trade. But this trade again gave me so much headache. So I had seen some money, that money disappeared, all of it. So I was aiming for that trade to look like that. Then my stop loss, as we all know, it comes in line with risk-reward ratio of 1:2 risk-reward ratio. So that was the trade idea that I had. And you can see the market performed really well. After a while, markets dropped just that Monday by 5. Markets were dropping pretty well towards my target. Then we had this some fundamental news coming in on Tuesday again. I think it was CPI numbers. Yeah, we had CPI numbers again coming out on Tuesday last week. So markets again dropped sharply close to my target. This was a very quick move. Even on the 15-minute chart, it was just one candlestick, and the market came so close to my target, didn't really attain my target. So it retraced all the way back to entry, came back again almost 50% again. Then the moment it came back to entry again, I exited that trade. So this was a trade whereby I had seen almost $800 going back all the way to being zero. So trading is that difficult, my people. You'll see money some days, money will go. Yeah. So that was the trade idea I had. At least I got it at break even, didn't really suffer the loss. But that is because, again, the market had moved significantly to my side. Sometimes I accept to suffer the loss, not that every time now I break even my trades. Actually, most times if a trade is working out, I won't break even my trades. But after some market movements and some fundamental events happening in the markets, I can choose to break even some of my trades. So that was the loss I had for last week on US30. This week again, same thing, rinse and repeat. In trading, you always have to repeat your process. Your process has to be a similar process. So last week again, you can see markets pushed to the upside, moved towards the R3 level, didn't really close at R3, but this was the close for last week, this candle here. So you can see markets had moved extensively to one side. And this week when markets opened now, if I can zoom in here, you can see markets now opened towards R1 level. You see that again for me is an inefficiency similar to last week. The markets didn't open towards equilibrium, so I again took a similar trade, a similar short trade from last week, doing the same thing again, taking the same risk. As long as my criteria is the same, I know my entry. So on this trade, I didn't really catch the first entry, but I caught this secondary entry here yesterday at 5 p.m. or that was on Tuesday 5 p.m. You know, this is recorded, so you might just ignore the time that I'm saying. And this trade just materialized right now. It just closed right now. So the idea here was similar. My risk reward was about 2.4. Yeah, 2.46, I think. Yeah, so you can see the idea is the same. Markets to move from R1 level back to equilibrium level P. And you can see that is how that trade has worked out. So pattern last week, which was a loss, this week again has become a win. So that is what I'm looking at on US 30. Trade has matured. I also had a similar idea on US 500. But again, just to diversify my trades and my risk, I haven't taken all trades. So again, you can see similar thing. Markets last week were at R3. It came, we touched R1, there was a signal formed. So this again is an idea for a short trade for me. Just a quick pullback before the market continues to move to the upside. So from the strongest resistance of last week, touch and rejection of R1. So I call this R3 plus R1 combination. A very powerful setup. Works like magic. So risk reward again, I like my stop losses a bit wide. Risk reward a bit, average. So I don't really go for big risk rewards like maybe 1:3, 4. So I'll try, keep my stop losses a bit wide, a bit safe from the praise. And probably this is another idea, another possible magnet trade. So that is another setup that probably you could have executed as a magnet trader. But for me, since I had a trade on the US 30, I avoided that. US 500. I didn't really have any idea towards USD yen. So yen, again, I can see yen opened towards close to the P level. So I can say this is at equilibrium. But let's look at if the dollar strengthens, the yen has been weakening a lot. So the yen, so if dollar strengthens all the way to 158.5, I can look for possible shorts. So I can look for possible shorts from the R3 level, but I don't see that happening sooner. Probably markets will just stay within the fair value zone, and probably I don't look at any trade happening around this level. For the dollar, same thing. Last week again, I avoided trading this short R3 on the dollar because this time is when we had inflation numbers. So it was this specific time. I didn't want to trade during that time, so I was out of that market and I saved myself from a loss again. As I always say, fundamental risks, you should really be aware of when these numbers are coming out and try so much and not be caught up in the madness of the news. So I avoided that trade. This week, nothing much on the euro. I was aiming for the markets to come and touch R1 for us to get probably a double rejection of that level back down to the P level. But you can see the markets has attained efficiency without touching the R1 level. So most of this, what I'm talking about, is my personal strategy. So actually, I'm really saddened to share all this. But again, enjoy it. So, but probably again, it might not be the best way to learn it because I'm just rushing through what I look at. Probably you might not understand the idea or the philosophy behind these trades. For me, nothing much on the dollar, on the euro dollar. The trend is to the upside. Dollar is looking to weaken. The euro is a bit stronger. Dollar is weakening. And that is because, again, I've mentioned the dollar is pricing in lower rate cuts in the long term. So probably that is why the direction is starting to pick up earlier. So currently on the euro, I'm flat. Euro yen also flat. So just waiting probably if the euro continues to move up, as we've been seeing it move up, probably to the R3 level, markets can again have a short-term correction before the trend continues. Gold has been a very interesting asset to trade. If you look at gold over the long term, gold has really moved up over, like this year. So in the weekly chart, you can see gold early in February we were at 1993. Currently we are at 2391. That is how many pips? About 4,000 pip move in less than 3 months. So, you know, gold is always a safe haven. You know, I think we know about that. We've talked about that in multiple videos and podcasts. And anytime, you know, there is drama in the world, there is, you know, insecurity, you know, threats, war, you know, calamities, the gold market just, you know, spirals up really, really sharply. So I've been trying to trade gold a bit differently, cautiously, basically, because of the clear direction that it's forming. Because you realize, for me, I try to catch some short movements to the downside within a trend. But for markets like gold, I really, really try to avoid even oil. That is why I don't trade oil. If it was a market like, you know, I see last year was a consolidating year. Yeah, down, up, up. But now this year it's clear that, you know, markets are moving to one direction, so it might be very difficult for me to be strongly opinionated, to be a contrarian trader, to catch short-term corrections. You know, it's very good to understand the strengths and weaknesses and which markets you can work around with. So not everything, again, will work for you every other time. Sometimes markets will be out of sync. Like now I can say the gold market currently is probably out of sync with my system. But yeah, I'm just watching it. You can see last month markets again moved to the R3 level, multiple short-term corrections. Again, another trend continues. This month we've rejected the R2 level. Gold this week, today actually we've had some 1.1% down. So gold is pretty down for the day. For the week it started strong after the Iranian president died. We saw gold really moving up early that Monday morning. But within the week, on Wednesday evening, currently, you can see markets have moved back to equilibrium. I still expect gold to move up, so probably we can see a move from gold. I don't partake in such trades, but I think there's a clear trade that gold can move sooner to the 2500 levels. So I'm aiming for that level, 2500, to be hit sooner than later. So depending on if we can get that momentum to the upside, markets can get to the 25k level, 2500 level, then probably get some short-term corrections again, like how we saw at this level. So from the 2400, I'm aiming for the next, again, 1000 pip move to the upside, so to 2500. But that is a move that probably one of my colleagues will take. I won't really partake in that move. I'll try to look for some reliefs around this level, 2500 levels, for some short-term corrections. That is on gold. So on gold, no trade, but strongly bullish on that market, expecting some movements to the upside. The Japanese yen has been weakening, you know, sharply. A lot of volatility. Japan, I think it was towards the end of last month, we saw them raising rates from negative territories, and that is why we can see some volatility here. We saw the yen really gained ground for a few days. Then again, after the interest rates were hiked, it was really positive for the yen for a few days. There was so much volatility here. But again, that move again quickly faded. And we just saw again the yen again losing all of that momentum to the upside. And again, yen has been falling. And that is because the central bank in Japan, the Bank of Japan, sort of has failed to, you know, give a clear indication of how they are going to intervene on the devaluation of the Japanese yen. If they can give us a clear indication of that, I think the yen now can gain some good ground. But until that point, you know, yen again is a pretty tricky pair to trade because of government intervention. The central bank intervenes on valuation of the currency, and either valuation or devaluation. So that is on the Japanese yen market, a lot of volatility. If you're trading that market, trade it with minimal risk probably. I don't have any idea at the moment, probably just waiting for some short-term buys from the S3 level. This is the yen index, the yen index, so it is a mirror of probably what can happen on euro yen or pound yen. So I like understanding it from an index perspective, same way we look at the DXY. So yeah, for the yen pairs, yen is weakening, but probably towards the 709, 710 level, we can get some relief, and markets can bounce up a bit. That is on the yen pairs. So that is what I've covered for this week. I think, I had one trade also on pound USD, which was a loss. So yeah, pound USD again, I had a trade this week. It was a quick loss just today. Markets had, when that news came out at 9 a.m., markets had that spike to my stop loss. I entered that trade on Monday, so I was ready for fundamental risk. But as you can see, markets, again, from the R1 level, I was aiming for that move to come to the P level. And my stop loss was at that point. So you can see that trade was spiked out. So my first loss of the week. Then the US 30 has been my first win for the week. So I'm up about 1% for the week after losing on this. So you can see that this spike, it happened during that fundamental news at 9 a.m. Inflation numbers came out positively. But pound again spiked up. So I look at this as sort of just a spike, but because if probably inflation has really gone down to 2.3%, that should be really negative for the pound, you see, because sooner pound will probably lower rates. If they're going to lower rates sooner than the Americas, probably we'll see the pound again shifting the direction for the year now. Probably you can now see a change in the direction for the pound. So we can see something like a move to the downside again. Okay, so something like that. So that is what I try to pass along on the pound. So that is my idea on the pound. Probably long term, I'm bearish, especially now with lower interest rates from the pound. Really promising 2.3% against a 2% target. Really good. But yeah, so I still look at, when I look at the 4 hours, I'm still expecting probably the pound to weaken. I was looking to come into that short-term correction this week, early in the week. Then the trend could have continued. Then I'll have got again another contrarian trade from the R3 level. But that is that. So I think I've covered a couple of markets. I was not really to cover so much. The idea is to just share with you a different perspective from how I analyze markets. And if you want to understand a lot of how I do what I do, and the idea, the philosophy behind it, the data behind it, because I have so much data again behind it. Maybe I can just check on one of them. Yep. So this is the statistics of this asset from about 2004 to 2009. I'm not done with this yet, but this is just one sample. So you can see a win rate of 66 and an average IRR of 2.25%. Winning streaks 13 in a row, losing streaks about 5 in a row. So it's a very good system for me personally. If you want to learn more about it, you can enroll for our classes. I think you're aware that the first 2 classes at Financial Lab are free, so you can sign up. I think there's a link for signing up for the free classes on the video description. And we look forward to sharing with you these ideas that we have about markets, because the market is big and the markets are for everyone. No one can, finish up the market. So I think I've done about a 40-minute talk, so that is pretty long. But I hope you've learned something. You can share this with friends and family. If you have any questions, you can DM us on our Instagram. You can call us on our number. I think our number is also on our description. Or you can just visit us at Lavington Mall, Chandarana building. I will stop there for today. Thank you so much for listening, and thank you for watching. Thank you.